So markets continue to power higher on Tuesday despite a strong beat here of job openings. And we can see here if we've potentially hit a rock bottom here ever since 2022. So the monthly rate of change is looking interesting here. And the question is, what will the Fed do with all this? So here's the print. We can see here that it was forecasted to be 7.1, all we beat by almost 290,000. So that's a pretty strong number here. The 2-year yields remain range bound here below all key MAs. We believe that this will catch up to the dollar's decline. So the 2-year is looking bearish here in our view. Now, if we take a look at the yields here across the curve, we see here the 30-year is making new highs. 20-year is approaching that level as well, closing in. And moving forward, we're going to just have to see what the 10-year and the 2-year will do. Although we remain very biased here towards the downside. And if we take a look at the market performance yesterday, we saw a mixed bag here of performance of the Mag 7s here. Google was down, Meta was down, but we've been eyeing on Nvidia and Adobe. So these are interesting stocks that we have pointed out in our X account. Now in today's video, we're going to take a look at the macro data and you will find out why we remain bullish on this market long term. And lastly, we'll also take a look at the technicals just to guide us where we currently are in the market. So this video is packed today, tons to dive into. I'm Danny, by the way. Welcome to the channel. It's time to start the show. Let's kick things off with some fresh economic data. This chart from Goldman Sachs shows that job openings were higher than expected, which is great. It means companies are still hiring, but factory orders came in below what people thought, which isn't so good. It's like the economy is sending mixed signals right now. So Goldman says they're keeping their Q2 GDP estimate at 3.3%, which sounds solid, but I'm curious, how's this affecting the overall financial environment? Let's check it out next. Okay, so this chart is called the Goldman Sachs Financial Conditions Index, or FCI. It's been trending down lately, which is actually a good thing. It means financial conditions are getting easier. When conditions are easier, it's better for economic growth because it helps both consumers and businesses. But Goldman warns we still need to watch out for inflation risks. So things are looking up, but there is a catch. So let's dig a bit deeper into what's driving this improvement. Now, this chart explains why things might be getting better. Goldman says that while hard data like factory orders has been solid since May, the soft data like surveys of what people think is starting to improve too. This chart shows something called the GS-US CAI, which tracks economic activity. The soft data has been climbing lately, especially because of a better trade policy outlook, so the economy might be picking up steam, which is awesome. But how's this affecting the stock market? Let's see what's happening there. Now, this chart is exciting. It shows that foreign investors are pouring money into US stocks, on track for 138 billion this year, which would be the second best year ever. You can see the big spike in 2025, and it's not slowing down. With the economy showing signs of improvement, it makes sense that investors from around the world are jumping in. But it's not just foreign investors. Let's see what regular folks like you and me are doing. So this chart says retail investors or private clients have been buying US stocks for 25 out of the last 26 weeks. That's a record streak going back to 2008. And according to Bank of America, they're net buyers by about 0.8 billion over the past 4 weeks. It's like regular people are feeling really confident about the market right now. And it's not just them. Companies are showing confidence too. So let's see how. So this one shows that the S&P 500 companies are buying back their own shares at a crazy rate in 2025. They've announced $192 billion buybacks over the past 3 months and $160 billion in just 1 week. That's a huge sign of confidence. Companies think their stocks are a good deal, even with all the economic and political challenges out there. So both retail investors and companies are feeling good. But how's the market actually doing in a bull run? Let's take a look at that next. Now, this chart gives us some perspective. It says the third year of a bull market, like 2025 is right now, is usually pretty weak. Since World War II, the S&P 500 has only gained 5.2% on average in year 3. Plus, in the last 11 bull markets that lasted over 2 years, there was always a correction of at least 5%, and 5 of them dropped over 10%. The S&P 500 is up 65% since its low in October 2022, which is 31 months ago. Historically, bull markets last about 55 months, so there's room to grow, but we should expect some bumps. So let's see where the S&P 500 is in its current cycle right now. Okay, so this chart is super interesting. It's called the S&P 500 Cycle Composite for 2025, and it combines the 1-year, 4-year, and 10-year cycles to predict where the market might go. The S&P 500 has been following this cycle pretty closely so far this year, but you can see it's predicting a dip soon, maybe in the next few months. After that though, it looks like the trend could pick up again into 2026. So we might see some short-term challenges, but the long-term picture looks good. And that got me thinking, how are different parts of the market doing right now? So this chart shows that small cap stocks like those in the S&P 600 are underperforming large caps like the S&P 500 by 36% from March 2021 to July 2024. That's the biggest gap ever outside of a recession. Now, historically, small caps have lagged large caps by about 31% on average during these periods. They could be a great opportunity if rates come down, but the chart says they might not shine until we get a higher for longer rate environment. So let's wrap up by looking at who's buying and selling in this current market right now. Finally, this chart breaks down who's buying and selling US stocks. We already know retail investors are buying, but that's the private clients here. With 0.8 billion in net buys, hedge funds have also flipped to buying with 0.2 billion over the past 4 weeks, which is the first time since December 2024. But big institutions are still selling with 1.6 billion in net sales, though that's down from their peak. So it's a mixed picture. Retail and hedge funds are in, but institutions are still cautious. That's something to keep an eye on. Let's switch over to TradingView, and as we can see here, the S&P 500 managed to get above this 21-day EMA, and we have successfully broken above this POC line. What's left here now is just to get above this value area high, which I believe the S&P will clearly take out. So this is an impulse here towards the upside. So we are eyeing obviously these auctions here, and ultimately, just like we said before, this is an all-time high here that I believe that the S&P will knock out very, very soon. So it's looking very constructive and bullish here. You can also take a look at the QQQ showing the same price action. There are a few open gaps here that we are a little bit worried about, but if we're going to get a correction before the next upside move, then these gaps here could likely be filled. So then we're looking for just a retest here of one of these moving averages. But for now, that we have a golden cross here of the 55 and 233, this is a bullish market. Let's also take a look at the Russell 2000, and we talked about this trend line before, and we have successfully broken above that trend line now, and it looks like the Russell 2000 will break above this 233 as well. I love setups like this when we have a retest here of the 55 and then we're just bouncing above these levels. Very, very bullish here, and it looks like the Dow Jones is laggard here, but obviously same thing here. We got a retest here a couple days ago of this 55 233, and now it looks like it just wants to get up higher. Let's also take a look at the US dollar. The dollar has been muted a little bit. We are still below this POC line here, and we're just watching if the dollar is going to catch a bid, because we haven't seen a break of new lows here. And we thought that perhaps maybe the dollar could see a little bit of a corrective upside move before resuming lower. So we'll keep an eye on the dollar here, the VIX as well. We have not made new low here, but if you look at the VIX has moved pretty much in line with the US dollar recently. So as the dollar goes down, so does the VIX. So if the dollar starts to catching a bid, we will be watching the VIX as well. Let's move on and take a look at the commodity markets, looking with gold. Gold is not making so much moves here. Looks like it's trying to break above some key levels here, still below this value area high. So we got a breakout here now. It looks like we just want to retest this level, and we're above these key moving averages here, but look how extended we are above this 233. So I do suspect that we are going to see continued correction for gold before resuming higher. We're always long-term bullish on gold here. And let's move on and take a look at silver. Silver is consolidating a little bit here, and it looks like it wants to perhaps retest this former breakout level before resuming higher. Let's also take a look at bonds. We look at TLT here, and it looks like this thing just wants to just keep on moving lower, but that's something we believe will end soon, because if we take a look at bonds here, it looks like we're getting a double bottom, and this is an area that we're watching because we looked at the 10-year previously in our initial charts, and we think that based on the technicals here, we do believe the 10-year will break down from these levels. So it's just a matter of time here. If the yields start breaking down, it will obviously start to catch up to the US dollar. And from that sense, we do believe that maybe we could see some correction in the markets just to test some levels before resuming higher. This is the gap we talked about earlier, or maybe a final opportunity just to close this one before resuming higher. The reason why I believe we could continue to see some corrections is because when I look at Microsoft left a huge open gap here. And I don't know about you guys, but I don't know if this one is going to be retested, but if we're going to retest this level, or at least the bottom here of this gap, that means that we're going to break below the 233 and the 55. So that's very bearish. And so we're watching closely Microsoft here. And if it looks like Microsoft wants to break down, we're going to be a little bit more cautious here for the major indices. However, we are bullish long term, and a correction here will be just a add-on to our position. So this is how the market is looking at, and we're not going to take a look at the crypto markets because I believe that the crypto markets have stalled now, so nothing has really changed, but we're keeping out on the major indices for the next couple of days. And that was it for today's video. And as we looked at the charts, there's a lot pointing to more bullish sentiment in the markets. We got the share buybacks. We have a lot of things supporting the markets higher. Obviously, anything could happen. And this is why risk management is very important, where you put your stop level so you can always get out. But you should always participate in a market that wants to go up. So that was it for today's video. Thank you so much for watching. You can follow me on X for the latest things I post, stocks that I buy. So I'll see you guys in the next video. Have a great one.